Have you ever looked at a trading chart and wondered how experienced traders seem to predict where the market is heading? The secret isn't magic, it's understanding candlestick patterns. These simple-looking candles tell powerful stories about the battle between buyers and sellers, helping traders spot potential reversals, continuations, and profitable opportunities before they happen. If you're new to Forex or binary trading, mastering candlestick patterns is one of the smartest skills you can learn. In today's video, I'll walk you through the most important candlestick patterns every beginner must know. Stay until the end because one pattern could completely change the way you trade forever. What are candlestick patterns? Before learning individual patterns, it's important to understand what a candlestick actually represents. Every candlestick shows the price movement during a specific period of time. Depending on your chart, that period could be 1 minute, 5 minutes, 1 hour, for hours, or even 1 day. Each candlestick has four important prices: opening price, closing price, highest price, lowest price. The thick part is called the body, while the thin lines above and below are called the wicks or shadows. A green or bullish candle means buyers were stronger during that period because the closing price was higher than the opening price. A red or bearish candle means sellers dominated because the closing price ended lower than the opening price. One candle alone doesn't tell the whole story. The real power comes from recognizing patterns that form over 1, 2, or 3 candles. These patterns reveal market psychology and can help traders anticipate what might happen next. Remember, candlestick patterns don't predict the future with 100% accuracy. Instead, they increase the probability of making better trading decisions when combined with support and resistance, trend analysis, and proper risk management. The Doji pattern. One of the easiest candlestick patterns to recognize is the Doji. A doji forms when the opening and closing prices are almost identical. This creates a candle with a very small body and long or short wicks. The doji represents indecision. Neither buyers nor sellers managed to take control of the market. Both sides fought hard, but neither won. Imagine two equally strong teams playing a football match that ends in a draw. That's exactly what a doji represents. When a doji appears after a strong uptrend, it can suggest that buyers are losing momentum and a bearish reversal may be approaching. When it appears after a strong downtrend, it may signal that sellers are becoming exhausted and buyers could soon take over. However, beginners should never trade a doji by itself. Always wait for the next candle to confirm the market's direction before entering a trade. Hammer and hanging man. The hammer and hanging man look almost identical, but their meanings depend on where they appear. A hammer forms after a downtrend. It has a small body near the top, a long lower wick, very little or no upper wick. This pattern tells us sellers pushed prices much lower, but buyers fought back and closed the candle near the top. That buying pressure often signals a potential bullish reversal. The hanging man has the same shape but appears after an uptrend. Although buyers managed to close near the top, the long lower wick shows sellers were able to push prices significantly lower during the session. This can be an early warning that bullish momentum is weakening. Always wait for confirmation before taking trades based on either pattern. Bullish and bearish engulfing patterns. Engulfing patterns are among the most popular candlestick formations because they clearly show a shift in market control. A bullish engulfing pattern consists of 2 candles. The first candle is bearish. The second candle is bullish and completely covers or engulfs the previous candle's body. This signals that buyers have overwhelmed sellers and may be taking control. It often appears at the end of a downtrend and suggests prices could start moving upward. A bearish engulfing pattern is the opposite. The first candle is bullish. The second candle is bearish and completely engulfs the previous bullish candle. This indicates sellers have taken control and a downward move could follow. These patterns become much stronger when they form at important support and resistance levels. Morning star and evening star. These are 3 candle reversal patterns that beginners should definitely know. A morning star appears after a downtrend. It consists of a large bearish candle, a small candle showing indecision, a strong bullish candle, This pattern tells a clear story. First, sellers dominate. Then momentum slows. Finally, buyers step in aggressively and reverse the trend. The evening star works the opposite way. It appears after an uptrend. It starts with a strong bullish candle. Next comes a small indecision candle. Finally, a large bearish candle confirms sellers have taken control. These patterns are considered stronger than many single candle patterns because they demonstrate a complete shift in market sentiment over multiple candles. Shooting star and practical trading tips. The shooting star is another powerful reversal signal. It appears after an uptrend. It has a small body near the bottom, a very long upper wick, little or no lower wick. This tells us buyers initially pushed prices much higher. However, sellers entered aggressively and forced prices back down before the candle closed. This suggests buying momentum is fading and the market may soon reverse downward. But here's something every beginner needs to remember. Professional traders never rely on candlestick patterns alone. Instead, they combine them with trend direction, support and resistance, moving averages, RSI or other indicators, proper risk management, confirmation candles. Avoid entering trades simply because you spotted a familiar pattern. Always ask yourself, is the market trending? Is the pattern forming at an important level? Do other tools confirm the setup? The more confirmation you have, the higher your chances of making quality trades. Also remember that risk management is more important than any candlestick pattern. Never risk more money than you can afford to lose. Even the best trading setups fail sometimes. Successful traders focus on consistency rather than trying to win every single trade. Learning candlestick patterns takes practice. Open a demo account, study historical charts, and challenge yourself to identify these patterns every day. The more charts you analyze, the faster you'll recognize them in real time. Eventually, spotting candlestick patterns will become second nature, allowing you to make faster and more confident trading decisions. Candlestick patterns are one of the most powerful tools every beginner can master because they reveal the story behind every price movement. From the Doji and hammer to engulfing, morning star, evening star, and shooting star, each pattern gives valuable clues about what buyers and sellers are doing. But remember, no pattern guarantees success. Always combine candlestick analysis with trend confirmation, support and resistance, and proper risk management. If you found this video helpful, give it a thumbs up, subscribe to UchiengFX, and turn on notifications so you never miss our next Forex and binary trading lesson. Happy trading!